All right, so we're getting up close to the end of the course here. I wanted to go through some people asked me a couple quick things about business organization, a little about real estate that I don't feel were covered as well as to make things more complete. Um, Anybody who's got their project ready to turn in, you can go ahead and do so. Same with the homework. With the project, if people are still, not quite sure of their final product, you can always hand it in, tentatively, just email it to me. But on the final copy, obviously, you're going to submit it via Blackboard. But if you want me to have a look at it beforehand, that's fine. But most people, they do pretty well. They'll get, enough in terms of content. They'll make it useful to themselves, and then they'll kind of adhere to, not APA kind of stuff in terms of a term paper, but just making it, a paper that is you know readable, not just a list or a you know series of diagrams just strung together with a few bullet points. But anyway, so let's jump into this. Business organization. There's different ways of setting it up, and I kind of touched on this last week, and it really comes into be critical in terms of estate planning. If you are in a sole proprietorship, that's just dead easy. You just go in, you say, I'm going to open up a business, but you can see the problem right here, unlimited liability. Um, so you can get sued, you can lose it all, including your house and everything else, because it's all tied back to you. Whereas if you have some sort of corporation, there's a limited sense of liability. Now, what they're talking about here is a C class stuff. So if some of the stuff is kind of beyond, your realm of comprehension, don't sweat it. But what I'm saying though is if you do decide to get into a business, and even if it's renting homes or doing income property, it still makes sense to set it up in most cases in some sort of uh, corporation, more appropriately, probably an LLC that I'll talk about on the next page. Partnerships are typically a bad deal. What you have here is not only do you have your unlimited liability, but you also have that knucklehead, whoever you chose to deal with. And so, again, this isn't even a marriage. You're not bound by anything other than business interests. And so I try to steer away from partnerships because there's just not a whole lot of advantages to them. Uh, S Corp, I'm actually an S Corp now, but that's more of a, it take me too long to explain that well beyond the course here, but an LLC is quite popular, um, taxed as a partnership, but that limited liability and avoids personal lawsuits and does a lot of things for you. But that's how most people get set up. So this is just a review. The reason why people do it is because it's easy, but that's not a great idea. You know, in terms of corporations, yeah, there's a ton of sole proprietorships. But if you looked at the total assets, the corporations, the big corporations, C class corporations, would be much, much larger. Um, so advantages, easy, keep all the profits, minimal regulation, can be easily dissolved, but unlimited liability. Uh, you know, Trying to get a loan is also going to be difficult since it's tied directly to one person. Higher taxation rate, it's all going to go on your personal income. Partnership, yeah, not a whole lot of advantages there. The you know main disadvantage I say though is well, the liability situation doesn't really go away, and if there's two partners, then it's doubled, or three partners. You can, but everybody has to agree. So it does get kind of complex in terms of how the partnership is set up. So you're going to be involving a lawyer also, and why not just do it, in a different manner. Um, so again, these are some keys to partnerships, but what I'm looking at is more the personal finance aspects of it. list of assets, you can see how things would get complicated, arguments could ensue, and partnerships could dissolve. So easy to organize, swift decision making if you agree, but this unlimited liability. Again, most people get involved in these things. So really the aspects I'm covering here, the management aspects. There may be particular characteristics that you like or don't like, but from a personal finance standpoint, a partnership is not something that most people would look fondly upon in terms of the liability part. Taxes, not a whole lot of shelter there provided. Now, a regular corporation, I've actually had a C-class corporation, and there weren't many benefits to it. It was just a little bit more involved. But these things about being sued and can be sued in court, that's true of LLCs as well. They can enter into contracts. You want to make some people angry. You talk about a corporation as a person, and legally it is. So that's why it's able to live on. That's why it's able to have some of these, characteristics like being able to sue and be sued. And the majority, because most people, are smart. I can do stocks, it can do dividends. Again, this is beyond personal finance here, so we'll step right through this. Foreign corporations, IPOs, not going to mess with this. Boards of directors, preferred stocks, common stocks. We talked about this in other parts of the class. Advantages, again, liability, but also their, the perpetual life part, but also the ability to raise capital, because they're selling shares and then expand to unlimited. It's not limited to just one person. Disadvantages. So the corporation is taxed, and then the dividends that you pay to your shareholders are taxed. So that would be considered double taxation. Expensive to form, can be, but again, it's as a relative cost compared to the overall size of the corporation. It's probably not going to be that bad. Joint ventures and S corporations. So S corp is just some extra paperwork I file to be filed as an X corp, but it allows for quicker depreciation on everything I own, which I really don't own much because it's all owned by the corporation. Limited liability, very popular. Cooperatives, these are for things that are nonprofits and things like that, where it's, it doesn't have to be a nonprofit, but it's more of a different style, not typically for typical businesses. You see a lot of dairies and other things set up in that manner. All right, so that was just a quick overview. Wasted a few minutes on that. And now I'm going to talk quickly about real estate purchase process, just to answer a few questions that came up. Searching for a home. So again, there's tons of agents out there, but you don't want them. You want that, the best, the top 5% or so. And those people are not going to deal with you unless you're pre-approved. Now, first off, the question of looking for a home, do you want to use one or, use an agent, a salesperson or not? As a buyer, you don't pay the commission. So that's kind of a no-brainer. Some people, will look for the for sale by owners, but a lot of times those, as an agent, haven't been involved in some of those transactions. It's usually the transaction that happens afterwards. You're looking at inspections that weren't done, paperwork that wasn't filled out, and I'm talking the sale after the for sale by owner, where things just maybe don't get complete. All the little legal parts aren't completed. And the way I had a number of people who wanted to sell a home, and the way it kind of goes down is they want to sell their home for way more money than it's worth, because everybody thinks their own home is pretty special. And so as a agent, you walk in and you say, yeah, no, the market won't support this. And so the people get kind of upset and they say, well, you know what, I'm going to sell it myself then. So the notion that it's going to sell for a cheaper price, that's not typically the case. Usually it's somebody who thinks their house is worth more than it is. Or, the seller has to pay the commission, right? So they don't want to pay that commission. So again, they're not necessarily giving a bargain because they want to make a little bit more money off it. If they wanted to sell it for the same price that an agent could get, then they probably wouldn't be interested. So, okay, so this all gets back to the pre-approval. You go to a mortgage banker or you go to a real estate person, you say, hey, I'd like to, look at some houses in the future, but first I want to get pre-approved. Do you have a lender who you might suggest? Or you can start at the lender and work it the other way. But the pre-approval is going to be something that's going to happen. In terms of the actual real estate, location, location. So for me, I'm not a big fan of subdivisions, not one bit, because they kind of all have an expiration date. They're always great when they're brand new, but then they just sort of whatever. They, in my mind, a lot of them go down a hill. Now, other ones that are maybe more mature and maybe have a location like on a river or lake, on the coastline, something like that, or some unique area, maybe downtown or something, that might work. But just a generic subdivision, I'm just not a big fan. Talked about the licensee. So Zillow and online services, um, man, up here they're just not reliable. I mean, just keep in mind that first off, Alaska's a non-disclosure state. So people don't, when you buy or sell a house, you do not have to, tell the government um, what it bought or sold for. So that makes it much more difficult for these companies who would normally go to the governmental agencies and find out what things bought and sold for. So then they go to the tax rolls, but the tax rolls are typically not correct. They usually underestimate things. And anyway, it's just a tough gig for these guys to come up with prices. Or certain things online will look great, but again, and especially in Alaska, you got something that's permanently in the shade, or you've got something that's in an avalanche zone, or you've got something that's basically a cliff, so you're looking at acreage and you realize, well, it's basically all vertical acreage. So the utility of those things can be a little bit more difficult, and especially in Alaska. Disclosures. The other reason why using a agent is because the seller will need to disclose any defects on the home that are known. So a real estate agent, if they, believe that their seller is hiding something and they're kind of witting of this, they can find themselves in big, big trouble. If they go to court, they're going to lose. And so most of the time you'll see these disclosures are actually pretty honest. There could be exceptions, but for the most part, especially if there's a licensed agent involved, they're usually very weary of getting burned in court. Homeowners associations can be a good thing, bad thing, up to you. But for the most part, I try to steer clear of them, but other people, love them. So up to you. Um, So, yeah, the rest of the disclosure plan, it can be pretty involved. Appraisal. The problem with appraisals is that the appraiser knows how much the deal is done for. So they're just sort of verifying the amounts. They're not coming up with the amount independently. And then also it depends what type of property it is. If it's a unique property that's different than, the others, well, then they're not going to have good comps. Comps are comparable sales, right? So if there haven't been a lot of homes like that sold, or the property's unique or something's different, they're going to have a tough time coming up with comps that they can use. They usually want, 3 or 5 comparable sales in the recent past in order to establish the price. So, but it satisfies the bank. But anyway, inspections, not a bad gig. A lot of times with property inspections, the inspectors will sometimes scare people off because they go through and they, make your dream house sound like it's completely about to fall down. But sometimes that's the personality of the inspector coming through. I've been fortunate enough to get actual engineers. There's a few of them out there that are not just property inspectors that go around and test the outlets and do things like that, but especially in the post, earthquake era, the earthquake a couple years ago, and obviously there's been other ones before, but it's important that the structure is looked at as well, or any damage that may have occurred is noted. Loan approval and commitment. So you're going to go through this whole process. It is going to take longer now, post 2007, 2008, when the big, ninja thing happened. I've gotten, I don't know, 15 different property loans throughout my career, and each time it seems like, well, at least the last couple, there's been a lot more paperwork required, and my financial position's actually improved, but they're just very, very averse to some of the practices that were happening a couple years ago. And then the final walkthrough, and also looking at some of those final papers. So you'll go through there. You're going to want to look at the home before you actually purchase it. Make sure all the stuff is cleared out of there, and do this days before you sign for it. And then the closing. So the closing should be kind of a non-event. If you've already walked through the home and your agent or the escrow, the title people have given you all the paperwork, say a day or so beforehand, you've had a chance to go through it. Now, what's going to happen is there's a lot of legal paperwork on here that is mandated by HUD and some federal agencies and stuff to make you aware of the terms of the loans and some of the other things. And um, you might want to sit down with the agent to have him kind of or her go through those details with you, because it's meant to kind of shock you again to make sure you're fully cognizant of the loan. And so sometimes some of the terms they place it in can be a little overwhelming. The term project, like I said, you guys are moving on with that. I'm happy to review, anybody's project beforehand, and that's about it. So I don't want to race through this stuff, but those were just a couple cleanup items I wanted to hit. I'm going to stop this one, and I'm going to start a review for the exam, and we'll go through that. All right. So we're going to review for the final exam. I'm going to go through the questions. There's going to be 72 questions. You're going to have 90 minutes to knock it out. And so we'll try and capture all the details that you would need to do well on this exam. So when we talk about a beneficiary, typically what is a beneficiary? We're normally referring to that in terms of insurance policy, right? And the beneficiary is the person who, your child, your spouse, your whatever, who is going to receive the proceeds from the insurance. So you are the, you know, insured, and they are the beneficiary. Beneficiary. When we talked about bonds, we talked about certain features that were available with bonds. Keep in mind, a bond is it's not it's can be a government bond, it can be a corporate bond, but basically it's a loan. Um, it does not represent an equity position. You don't own part of the company or the municipality. Obviously, you've just given them a loan. Now, sometimes there's a feature that enables you to convert that bond into stock. And if you have that type of feature, that's a convertible bond. Again, not super common, and maybe just because I'm not typically dealing with bonds, but it's it is a feature that's out there. Likewise with bonds, one of the not so nice things about a bond is if the interest rates change, sometimes let's say you're doing quite well, you've got a bond that's paying, 8%, and all of a sudden the interest rates drop and whoever sold these bonds could could sell, the next set and um, have the same features but only pay 5%, if that's what the market bears. Well, they really would rather not pay you your 8% anymore because obviously at the time they had to sell it for 8% because that's what the consumers demanded. But now if they can only pay people 5% and get away with it, they will do that. In fact, what they'll do is they'll sell more at 5% and they will call your bond. So there may be a call feature, and that allows that entity to basically take back that bond, call off the deal before the maturity date. So that's a call feature. It's not a good thing for you as the bond investor. Um, when we talk about policies where insurance policies, and say you have some sort of special equipment like some photography equipment or some nice jewelry or something like that, you need to let the insurance company know if you have something like that, because with your policy there are probably limits on certain categories of items. So you would need to specify insurance for say $10,000 of photography equipment, or $20,000 worth of guns or something like that. Anyway, they would have to issue kind of an addendum to that policy, and that's called a rider. Sometimes it's called rider is the term that we're using here, but it's uh, a special mention of those higher priced items to make sure that you have coverage for it. So it's an addition to that policy. It was called a rider. Um, when we're talking mutual funds, mutual funds is in terms of investments. Almost in all cases, you are looking for a no load fund, a fund, um, mutual fund that you don't have to pay a commission. Why? Because there's thousands and thousands of mutual funds out there that are no load. So, um, there's really no reason to pay a commission on one. It's kind of a sucker's thing. If somebody's pushing you on it and say, hey, get this mutual fund, there's only a small charge, that person is not your friend. They're not helping you out because you don't need their services to buy a mutual fund. You can just go and buy it and not have to pay a commission to anybody. Um, Mutual fund that invests in stocks that are rapidly growing or higher than average revenue. That's going to be a growth fund, right? So, you might have other funds that they'll list them differently. They'll call them balanced, or industry funds, or sector funds, or income funds. Income funds would be ones that pay dividends. Sector or industry ones would be ones in specific markets. Money markets might be one that just has government securities. But for this one, for rapidly growing, higher than average, that's going to be a growth fund. Mutual fund that invests in common stocks in the same industry. Typically, that's called a sector fund, right? In this same question, there are a few other, um, you know, other types of funds. Small cap funds is one they have mentioned in here. Small cap would be small capitalization, a smaller firm. And typically that'd be associated with a growth fund because it's just a small company that's obviously hoping to grow. But anyway, in this question, they're asking about stocks in the same industry, a sector fund, so like technology or medical or defense, or pick one. A mutual fund pools the money of many investors to invest in a variety of securities. So the primary reason for mutual funds is one, they're easy. You have a fund manager who kind of takes care of those, issues. The other part is you're not buying, shares on the market and placing orders so much. You just send in a check or do it online, and they just will ideally set you up where they're making a withdrawal from either your check or you're sending them a check or they're doing an automatic debit every month. They're just very, very user friendly. So that's one reason for them. But the other reason is the diversification. So because they buy a bunch of different stocks and then put them under an umbrella of a fund, you've got a little bit of protection due to the fact that you're not based on just a single company that might fail. You've got a mutual fund that's got a variety of companies underneath it. We didn't talk so much about liability. It's one of these issues on, you know, insurance and other things. But let's say you have a bad child. They, throw a baseball through somebody's window, and you're like, well, he's only 12 years old. It's not his fault. Guess what? You're the parent. You should have exercised a little bit of caution, and so you have vicarious liability over that child. Same thing's true if you're, even worse child, discipline him. He grows up and he, breaks into somebody's house and does a big party on Facebook and trashes somebody's house. You again, as the parent, get to enjoy the vicarious liability since your child, um, under your care, did something bad. Uh, Request that a stock be bought or sold at a specific price. That's a limit order, right? If you just say just buy it right now, that's a market order. And those are really the types we've done. We talked about some of the stop limits and some of the other trailing stops and other things, but those are more forms of limit orders. The main ones are market, just buy it right now, and limit, buy it at a specific price or sell it at a specific price. Stocks that trade for less than $1 per share, those are penny stocks. Not a good idea. We've all, not we, but well, we as in anybody else who's ever invested in penny stocks, has probably lost quite a bit of money doing it. Not, I mean, it's not money you couldn't lose, but watch The Wolf of Wall Street. You'll kind of realize how those things work. What happens is when you're dealing with those small stocks like that, they don't fall under the purview of the Securities and Exchange Commissions. They're not listed on exchanges. They're pink sheets or yellow sheets or what have you. And a lot of bad things happen, pump and dump kind of scams and a lot of misrepresentation stuff. And with the internet, it only makes it worse. So if somebody is telling you about the next big thing and it's some stock that's less than $1, be advised that they're probably selling you, trying to get you to jump into a penny stock. And it's all good fun. It's speculation, but it's not. It's not investing. Um, Again, for insurance purposes, let's say you've got somebody who's just wrecking cars and drunk driving and doing all this kind of stuff. They still have their license, but just barely. Well, no insurance company wants to insure them, but yet the state still allows them to drive. So they need to get insurance someplace. So states will have a provision where they'll force insurance companies basically to take those people. So up here they call it SR22. Other places it's different names, but it ends up being an assigned risk pool where they know these guys are not good drivers, but it's in society's best interest that they be insured, and so the insurance companies have to give them insurance, but not give them. They can charge them exorbitant rates, which they will. So, but if you ever hear of assigned risk pool or wonder how people with you know pretty bad driving records but still have their license, how they get insured, that's how it's done. A will. A will is a legal declaration of a person's mind. Uh, I'm referring to the disposition of property at their death. So it's a specific thing. It doesn't have so much to do with life support and the rest of that. It has to do with the property, and it has to be done, with witnesses and in accordance with the state guidelines, which usually involves a lawyer or at least a paralegal, and uh, that's how it works. This lady, she buys some shares. She pays whatever per share. She pays some commission. She sells it for a bit more, and she got a dividend. So you've got a bit of math to do. You got to figure out the starting price, the ending price. That will give you the, total potential profit there. You subtract out the uh, commission that was paid, but if you're smart now, commissions are typically zero on stock trades, but not in this case, they aren't. And then it got a dollar something per share um, over the couple years that they had it. So you got to figure in that dividend, and you come up with the total profit. This guy's thinking about investing in high risk with the hopes of earning a relatively large profit in a short amount of time. So that would be speculation, right? Get rich quick. So the other options were T-bills. That's not high risk, but it's not even going to keep up with inflation. Neither is the certificate of deposit. The low growth stock, you really don't see anybody advertising low growth. They'll usually try to characterize it as something else, but just to say it's a slug is not a common term. Or a low risk bond. Nope, nope. If you want these big earnings, you're going to have to, subject yourself to a fair amount of risk. Now, a fair amount of risk is, that can still be considered investing, but get rich quick, that is speculation. And in stocks, it's called a speculative stock, and in bonds, it's called junk bonds. So, anyway, um, this lady's got a health insurance company. She has to pay whatever $500 before the insurance company kicks in. That's a deductible, right? Just like when you wreck your car and you have $1,000 deductible. The car gets damaged for $2,000. You have to pay that initial 1,000, and they pay the second 1,000. Um, International tensions. So they're saying that, and this is actually, I was looking at gold charts today. It's kind of funny. Gold charts right now are, gold is going up, but that's only because it was in the gutter back from 2011. It's still trying to climb up to the level it was trading for prior to 2011 when it really went downhill. But it is going up a little bit. Anyway, easing of international tensions or disinflation is commonly said to cause gold prices to decline. And that is typically the case. The theory is that gold prices will go up in times of chaos or uncertainty. But what is kind of prevents that from happening 100% of the time is gold has a lot of industrial uses. And so gold and silver, they're used a lot in electronics. And so sometimes the reduced demand during a sluggish economy will make the price go down. For the answers of this test, you're going to be looking for a decline. So easing of international tensions or disinflation is commonly said to cause gold prices to decline, but can often be reversed by decreased industrial demand for metal. So I'm kind of giving you that one just because it can be confusing. But be very careful when people are pitching gold to you or precious metals and saying, oh, this is the way of the future. Look at a chart. look at a chart over the long term and not cherry picked. There's a lot of charts right now where they want to show you a 10-year chart because they want the world to start in 2011 when gold was in the gutter. They don't want to show you a 50-year chart where it's not quite back to the price it was trading for 50 years ago. So anyway, um, estate planning, it has to do with everything, primarily after your death. So, what happens to your property? What happens to your financial security? If your spouse dies, all that's covered under estate planning. Leverage, financial leverage. This is basically using borrowed money for investments. It's a smart thing to do with real estate. It's not a smart thing to do with stock market. If people are going, taking loans on margin to buy stocks, that can get quite ugly. Speaking of that, it's kind of funny what happened just these past couple days. You see, there's people who invest in oil futures, right? And these are big investors. They have, they live in big mansions, and they don't necessarily deal with oil. I mean, they don't want oil tankers showing up on their, front yard. So, but they've bought a futures contract. A futures contract, which is different than an option. An option is the right but not the responsibility to take delivery. A futures contract is the right and the responsibility to take delivery. So what normally happens is these investors, who don't own refineries or storage, things, uh, they sell these contracts well before they expire, and delivery is necessary. Well, a bunch of these guys took it a little too far, and there's no place to store oil right now. And so they went to sell their oil contracts, and nobody wants to buy them, and nobody has any place to store oil. And so they were trading for negative prices where they had to pay people. I think it got up to about minus 40, where they're having to pay people $40 uh, per barrel to take this oil off their hands, or else it's gonna, basically, well, who knows what's gonna happen? It's gonna be delivered, and they don't have the means to accept delivery. So it's just a curious thing that happened in the markets just yesterday. I don't recall it happening before. Anyway, um, for the average individual, regarding retirement saving, what do they need to do? Basically, save whatever they can, even a small amount. People are not good at that. People tend to put it off, or they'll say that, all my bills will be taken care of, or no. People generally need to save for retirement. This lady has a bunch of photography equipment, just like before, where we talked about the rider. And in this case, the other term I was looking for was floater. Sometimes you'll see the term floater used as well, and so that's why I put this question in there as well. So the other answers on there were umbrella policy. Umbrella policies are generally for liability, where you have $1 million liability. No matter what happens, it covers all types of liability, or personal liability. If you do something, if you wrong somebody, that's something that can be had, but it doesn't insure property. Um, and then this personal property floater, similar to a rider. This guy died without a will. What does that mean? Remember the term intestate, no will. This guy has assets. His will's going to be discharged. Where's that all going to happen? It's going to happen in the state court, the probate court. This lady is going to retire in 2050, so way off in the future. She wants a mutual fund that's going to kind of track and follow different investments, as she goes through life. So these life cycle funds, they tend to be in more aggressive funds when when you're younger, and they get more into income funds as you get closer to retirement, and that's what they're talking about when they talk about a life cycle fund. Interest rates on bonds. So, what happens to a bond? The reason why I said bonds are not a good idea right now is because if interest rates go up and you've got a bond, let's say, issued today at 2 or 3%, and interest rates go up and new bonds are issued that pay 5%, well, nobody wants your old bond, right? So your old bond, which, might have had a value of 20,000 when you bought it, if there's new bonds out there that are paying 5%, the most you might be able to get for it is about 15,000. So that's why interest rates affect the value of your current bond. Um, Another question on that. Yeah, we've covered that one. If you die without a will, that's intestate, and the state law kicks in. Um, Illiquidity. Illiquidity in any investment, especially real estate, means that you can't turn that investment into cash quickly. And that's particularly true of real estate. Um, why do you have life insurance? Typically to protect, um, your family in case the breadwinner is killed, dies. So it should match your requirements as you go through life, and ideally it should taper as you get closer to death, to a point where your retirement savings provide a sufficient nest egg where your insurance is no longer required. Another question on stock purchase, just, a certain number of shares, the price paid, the price sold. So you can use a calculator on the exam. There won't be any formulas on the exam. This lady, again, is looking for a firm mutual fund that has potential to earn above average profits. So again, growth stock is probably the best selection out of those. This guy bought a car with airbags, anti-lock brakes. What's he doing? Is he avoiding risk? No, he's still driving. Is he assuming the risk? No, that's something done by the insurance company. What he's doing is he is reducing risk. So it's risk reduction is what he's involved in there. How do life insurance companies come up with rates? When we're talking about rates, we've talked about premiums are going to go up as you get older, and that's because of the use of mortality tables, right? They're going to figure out basically the average lifespan, and as you get closer to that particular date, rates will go up. Young person, just graduated, which investments would recommend for a long-term program? So we've got some choices here: corporate bonds, government bonds, growth stocks, commodities, money market. So corporate bonds, government bonds, and money markets, those are all very sluggish, very stable. Commodities can be speculative, just like we talked about with oil, but growth stocks are going to be something that's going to typically have a above average yield. And since they're young enough, they will have time for, um, the blips to correct themselves. Most health insurance policies are sold to employers, right? So that's why most people in the United States get their health care coverage through their employer. So that's for most people, that's why it's affordable. And then you have, another segment that get it through Medicaid, the older, or the Medicaid is the welfare type program where it's provided, and then Medicare for the older folks, and then other folks either uninsured or perhaps they could go under the Affordable Care Act. But um, about 60-70% of the people get it through their employer. Based upon historical performance, an average of 10% yield. Treasury bills, no. Corporate bonds, no. Options, no. Stocks. Stocks, equities are where people get those kind of yields. And if you go back and look at from the turn of the century, previous century, um, 10% is the rough average. If you're going to be involved in mutual funds before you can invest in that, you need to read the prospectus, right? The prospectus are kind of the rules of the road. It tells the fund manager what they can and can't do. It tells you what kind of investments they're looking at and just the overall direction of the fund. And so there's a legal requirement that before you can invest money in that fund, you need to have read the prospectus. One of the main problems why I keep, talking about things like money markets or some of these municipal bonds or some of these other things and, savings accounts and in banks, why, those aren't considered good investments for retirement is because for the most part, they don't keep up with inflation. The buying power of your funds is going down. So that's inflation risk. Um, Talked about an annuity kind of being the opposite of life insurance. The longer you live, you're going to get a series of payments throughout the course of your life if you give them a certain amount of money. And the longer you live, the better deal it's going to be. So that ends up being kind of the opposite of life insurance. Um, if you have stock with a company, and I get these things all the time, you'll get a letter saying there's going to be a stockholder meeting. Now, it's not a perfect democracy. It's not one man, one vote, one person, one vote. No, it's one share, one vote. So, you know, if you've got 30 shares in a company and somebody else has got 30,000, they're not necessarily saving you a seat at the stockholders meeting. But what they will do as a legal requirement is they'll send you a proxy. And what you do on that is you basically fill it out if you want. And, your voting shares will be turned over to whoever you designate. I usually don't bother with it because I don't have enough shares in any given company to matter. But anyway, if you do own shares in a company, you'll get these proxies in the mail every time they have a big shareholders meeting. This guy is making a reasonable income. He pays his mortgage, utilities, and also does his investments right at the first of the month. What's he doing? He's paying himself first. So that's a good strategy for amassing money and making sure your savings gets done. She's contributing money to her 401k plan, different mutual funds. Um, there's an employee match of 5%. Should she do it? Yes. Take advantage of the employee sponsored program. So anytime there's a match on the table, you pretty much got to do what's necessary to make sure that you invest so that you get that match, or else you are, working for significantly less money. Back to insurance negligence. So Failure to take ordinary and reasonable care. So if you've got a swimming pool without a fence around it, if you've got, some dangerous situations out there and you're just allowing it to happen and people are able to, kids or whatever are able to come across your property and basically hurt themselves because you failed to take ordinary or reasonable care, yeah, you can definitely be found liable for that. And that's, well, you'd be found negligent and determined liable. So, advantage of a limited partner in a real estate transaction. I've actually done this, but the problem is if you're in a limited status, a limited partnership, or a limited investor, if you heard that limited term in a legal sense, you need to be very careful not to violate that because by being a limited partner, you do not have um, liability beyond your investment. If you go beyond um, and get involved in, say, the day-to-day management and could be considered a full partner, then your liability becomes unlimited and they can take more than just your investment. They can take your house and all that other worst case scenario stuff. When we talk about insurance, again, we talked about perils. So peril is what causes, um, you know, the damage. So fire, flood, hail, what you typically want is an insurance that's all perils. Like I said, flood is a separate program, administered by the federal government. But if your fence gets destroyed and they're trying to figure out whether it was the wind that did it or the earthquake that did it, all you know is you need a new fence. And if you had all perils, then you were covered regardless of what took it down. This lady's buying mutual funds that invest in companies that pay dividends. That would be an income fund, right? Growth stocks tend not to pay dividends because they're still growing. They're reinvesting their profits into expansion. Um, when we talked more about insurance, we talked about liability, right? So liability is in an automotive sense, it's the insurance that's required. Collision, for example, would be to fix your car when you're involved in an accident and it's your fault. There's no legal requirement to have collision, but there is a legal requirement to have liability insurance, meaning you have to fix the other person's car. Renter's insurance just covers your personal property. It doesn't cover the structure or any of that kind of stuff. Uh, this guy has a coffee maker that's known to cause problems. That's a hazard. That's a known hazard. The peril is going to be fire, but the defective coffee maker is going to be the hazard. This guy just received a bunch of money, deciding how to invest it. He wants to put it in a broad range of investments. That's called diversification, right? You spread it around a little bit. And a lot of times you can do that, through a mutual fund, but you can do it even more by, um, you know, if you want to go into individual investments and do it that way and just have a variety of them. We talked about beta. Beta has to deal with the volatility. So it's measured by the Standard and Poor's 500. The Standard and Poor's 500, S&P 500, has a volatility of 1 by definition because it is beta. So what happens is when stocks are going up and down, it's when somebody says a stock is volatile, it's kind of a meaningless term unless you have something to compare it to, because it's like saying the ocean is going up and down. Well, the tides go up and down all the time. So is it higher or lower than that sort of mean tide? Well, that's what the beta is. The beta is that sort of average tide, and a volatile stock goes higher and lower than the mean tide, and a low beta stock goes west would have like a beta of 0.5 or something like that. Anyway, stock that matches the volatility of the S&P 500 would have a beta of 1. But you don't have to do all that calculation. All you have to do is just know that the S&P by definition is going to be 1. The ease in which an investment can be converted to cash. So that has to do with liquidity. Remember, just like real estate is not a liquid investment, very difficult to turn into cash. Bond ratings. So it's looking for the highest bond rating. So your, answers out here are AAA, all caps, or capital A and 2 small a's, or A plus or BB. Anyway, uh, if it's saying the highest, obviously you're going to go with the AAA, all caps. Legal responsibility for financial costs of another person's losses is liability. So just like it's auto insurance, just like in property. Another investment calculation. It's just simple math. Typical uses of life insurance. Uh, basically to cover all those things that you had the insurance for. So paying off the home or mortgage, potentially setting up an endowment, making a charitable uh, bequest, paying estate taxes. This person owns stock in a company. There's going to be a stock split. So the actual question says they'll be receiving 2 shares for every one. So what happens is a company, their share price gets to be quite large. Let's say it's $250 a share. They're like, that's too big. What we're going to do is we're going to cut those shares in half, and for every, one $250 share, you're going to have 2 $125 shares. So it doesn't necessarily, represent a money addition to your account, but it does show momentum that the company is expanding. But the actual split doesn't generate any profit to you, but it's good to have companies that are having that kind of growth. When a stock splits 2 for 1, that price decreased to half the split price, right? So it went from, you had that 1 share at 250, now you have 2 at 125. Standard & Poor's, so the same S&P, a bond rating of something in default. Easy to remember, D. So A, B, C, but there is no Z. They don't, there's quite a bit of grade inflation. You get to D and you're definitely in the even C, you're borderline junk bond status. Disadvantage in real estate, as I've said, illiquidity. Um, they're looking for a true statement here. Again, it has to do with a stock split. A stock split may not cause a stock's value to increase. No, there's nothing about the stock value that's going to increase just because it splits. But it is indicative of a trend. If you're involved in an automobile accident, what should you do? I'm sorry, what should you not do? And that is discuss the accident. Admit liability, do anything like that. Just make sure people are safe, but don't make the situation any worse. Question about mutual funds has to do with, how many people have mutual funds, how many assets are in on them. It's huge, huge numbers. Trillions and trillions of dollars. Which one of these investments offers the greatest growth potential? So your choices were a bank account, common stock, corporate bonds, government bonds, or treasury bills. So out of that group, one of these is got a record of going up about 10% per year, and that's in the common stocks. Which of the following investments offers the least liquidity? So if you don't know anything about liquidity in real estate, you're going to miss about 5 questions. But if you do, you're going to glom onto the real estate being illiquid and you're going to do well. We talked about inflation risk already. Talked about term insurance. Does it build cash value? No. Is it expensive? No. Performance tied to the stock market? No. It just provides a certain amount of coverage for a specific amount of time. Are mutual funds guaranteed a higher rate of return than comparable stocks and bonds directly? No. The reason why you buy mutual funds is typically for the diversification. Um, that's the true statements. You buy it for the management part. You buy it for the sort of hands-off approach, but it doesn't necessarily guarantee you or ensure a higher yield. It just you could go out and buy those individual stocks. Just be a bit more work on your part. Um, Bonds are a form of debt capital. Correct. So stocks are an equity position. They are not a loan, but bonds are. Bonds are basically a loan from the you making a loan to the company. Who has the greatest need for life insurance? So children, no need at all. The parents need the insurance. Dual income couple, nope, they'll probably do all right. They may have a need, but probably not the greatest need. Singles living with parents, probably no need at all. Singles living alone, nobody dependent upon them. Households with small children, yes, definitely need insurance. Question on Social Security. You can depend on Social Security and your company pension to pay your basic living expenses. No. Um, you know, Company pensions a lot of times are gone the way of the past. Sometimes companies go bankrupt. Social Security is going to be pretty meager, so probably want a backup. And then the last question has to deal with auto insurance. So we talked about collision. Remember that protects you in terms of fixing your vehicle in case you get in an automobile accident and it's your fault. We talked about liability. Liability, um, fixes the other person's car when you cause the accident. But comprehensive is that other thing that, you know, for glass breakage, falling out, objects, vandalism, the rest of that is under comprehensive. So kind of a long exam, but there's actually a little bit of safety in there when there's 72 questions. It gives you a little bit more of a chance in case you miss one that the numbers will work out in your favor. So let me know if you have any questions. Again, turn in your homework. Good luck on the exam and turn in your term paper as well. And we'll talk to you later.